With Lori Calvasina. She's RBC Capital Markets Managing Director and Head of U.S. Equity Strategy. She's joining us via the phone. We also want to bring in our panel for the next 90 minutes. Yahoo Finance's Editor-in-Chief Andy Serwer and Dan Roberts are on set with us. Lori, thank you so much for joining us. So you have come out with an update to your year-end target for the S&P 500, although you acknowledge, of course, it is a rapidly moving situation. Your new target, 3279, down from 3460. So you're still expecting perhaps maybe a little bit of a gain this year. But what are you watching most closely as you are changing your models and your assessments?
Hi, so thanks for having me on. Obviously, this is a moving target, and we'll continue to, sort of evaluate the situation as conditions change. But look, I would say generally what we think is going to happen is that we're going to feel the economic impact of this mid-year. We're going to feel the brunt of the impact in stock prices early in the year, and we can still have a recovery back to sort of flattish equity markets at the end of the year. And that's really kind of how we're thinking about how this unfolds. Number one, I'll tell you, we've just been watching, how the market's been trading. To some extent, you have to listen to the market in these situations. And we told people all along, we thought 2,700 to 2,900 is where the market would settle in if this was a growth scare. And if the 2,700 level broke, we thought you could go down into the 2,300, 2,600 range, which would be pricing that's consistent with the average drop that we've seen peak to trough in recessions dating back to the 1930s. And I would say sort of beyond listening to the market, we're watching sentiment gauges very closely, both retail and institutional investors. This Friday, I'm going to be watching very closely to see where the CFTC data is on U.S. equity futures positioning. It has plunged in the last 2 weeks, but even with very dramatic drops, it was nowhere near the lows of '09 and other major bottoms.
Lori, help us understand why you still remain optimistic that we could end 2020 flat to possibly slightly up, given the fact that we have whole businesses. We have the cruise lines. They're going to not have revenue. They're essentially going to just stop for 60 days. You have the airlines under incredible pressure. Yesterday, we heard from United when they were saying we could see a revenue drop just this month and next month, 70%. This is going to have a trickle effect. So what makes you optimistic that we can recover sufficiently to have the S&P 500 close flat to slightly positive?
Well, what we've seen in previous growth scares is that if you really go back and look at things like the bottom we achieved in the fourth quarter of 2018, where we came very, very close to pricing in a recession with a 20% drop, we tend to see powerful rebounds off the lows once the lows are put in. And we did a quick analysis and really looked at some of these prior periods like 2011, 2016, 2018, and said, what's the average move that you tend to see after the bottom's in place 3 months later? And it's basically about a 20% move on average. Some of them were even a bit more powerful. And, underlying this idea for us is that the hole that we'll have in the economy that develops, there's very good foundation in this economy, and we think we can bounce back pretty quickly. But we do think people need to keep in mind that targets from strategists are year-end numbers, not, sort of where we think we're going to be in the middle of the year. And we think sort of the sooner we get this pain felt in the market, the sooner we can start on that recovery.
Hey, Lori, this is such a unique time. I'm just wondering, are you changing what you're looking at in terms of metrics and analytics, and what new things are you considering? What are you focusing on?
Well, I have a 200-page monthly chart deck for the S&P 500 and another 150-page one for the Russell 2000. So I think my clients would hope I'm not looking at too much that's new. But, I will say what we really do is we really try to stick to our process, and a lot of the things we're relying on now are things that we've always looked at. And some of these sentiment indicators, these valuation metrics we're looking back to past crises. We're looking to '01. We're looking to the financial crisis. We're looking to 2016 and 18. If there's anything perhaps I'm doing a little bit differently these days, I am really listening to the corporate commentary, whether that's reading through transcripts on conferences around the street, earnings calls that are coming out. We're really trying to get a sense of where corporations' heads are, because I think one of the pivotal things that will keep the U.S. from tipping into a recession is whether or not major corporations decide to lay off workers. And so far, we're not hearing indications that that's going to happen. This is generally viewed as a transitory event. And I think, the big corporations at least are going to try to get through this without laying people off. But we do need to listen closely to see if that changes.
Laurie, Dan Roberts here. That's a good point about listening to what companies are saying, and especially probably U.S. companies right now. But just to put things in perspective and context, I feel like right now and in the last few days, a lot of the market panic is obviously about coronavirus, or most of it. And especially in the last 2 days, it's coronavirus really hitting the U.S. more than it had before. Now, what's interesting, of course, is the markets already in the last year were facing global slowdowns and problems coming from outside the U.S. So I guess I want to ask you right now, when you look at what's happening in stocks, how much of it is now that, it has shifted, we're looking inward to our own country, to the U.S. versus, a year ago, Jay Powell was talking about, hey, there are slowdowns outside the U.S. globally, but right now the U.S. is very strong. Now it feels like there's a shift. We're looking really at America.
No, I think that's a great point. And look, I think we can look back to last year, and it felt like the recession fears were percolating. It was something that really kept markets on edge, especially in the first half of the year. That being said, there was a healthy debate about it. It wasn't a clear consensus, and I don't want to say there's a clear consensus that we're going to have a recession here yet. But it does feel like the concern is much different than it was. I will tell you, when I look back over my career, and I've spent about 20 years in equity strategy, the thing that this reminds me of actually is 9/11. And I say that because it feels to me like investors are not merely analyzing market developments, but there's also a real fear that this could touch people personally. We see that with the work shutdowns and that sort of thing. So I think this is just in a situation where emotions are running very, very high.
They are, and we'll tell you and everyone we talked to today, stay safe, Lori. Thanks for joining us. Lori Calvasina is of RBC Capital Markets, Managing Director and Head of U.S. Equity Strategy. Thank you.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.